The most commonly asked question is, should I buy individual stock or should I buy index fund? Because there are thousands of stocks and there are hundreds of index funds. And even you will find people are giving completely different opinions about this. One person says to buy only one index fund. Another person says if you want to build serious wealth, then you should only invest in individual stocks. And you will see that even a third person changes its strategy every week. And that confusion can stop people from investing, or it can push them into a portfolio which they do not like. So in this video, I'll show you a simple two-layer approach, a diversified index foundation, and a smaller group of individual businesses for people who genuinely enjoy researching stocks. This is not only a good strategy and the exact balance that will be different for different person, but it gives you a clear way to separate out long-term foundation from our individual stock ideas. So before we start, I want to correct one thing. No portfolio can promise constant growth. The market will decline at times. Even diversified portfolio can have different years. The goal is not to create something that only moves upward. The goal is to create a structure that a diversified, low cost, understandable, and easier to hold through different times in the market. So let us build a structure layer by layer, and starting with D1. Many beginners believe investing means finding one winning company before everyone else. Sometimes that works, and most of the time it does not. A person who identified a great business early and it held it for many years may earn an excellent return, but consistently selecting companies that beat the market is very difficult, even for professionals. S&P Dow Jones Indices publishes the SPIVA scorecard, which compares actively managed funds with their benchmarks. So in 2025, 79% of active large cap equity funds underperformed the S&P 500. So over the 5 years period ending in 2025, the reported underperformance rate for large cap fund was even higher. That does not prove that nobody can beat the market. Some investors and managers do. It shows that doing it consistently is much harder than it appears after looking at a very successful example. Individual stocks also create company-specific risk. A broad market can recover even when some companies disappear. But if one company represents half of your portfolio and that company fails, accounting problem, lawsuit, regulation, or management mistakes can significantly damage the entire plan. We saw this repeatedly in the market. Many strong companies such as Meta experienced very large price decline in 2022. When growth slowed and expenses increased, other companies never recovered because their businesses models became weaker. The problem is not owning individual stock. The problem is building a financial future that depends on one or two predictions being correct. That is why the first layer focuses on diversification. Layer 1 is low-cost index fund or ETFs. An index fund follows a defined group of securities instead of asking a manager to select every company. For example, S&P 500 fund gives exposure to roughly 500 largest US companies. A total market fund goes further and includes large size, mid-cap, and small-cap companies. And two common examples are Vanguard VOO, which tracks the S&P 500, and VTI, which tracks the broader US stock market. So as of Vanguard's April 2026 fee update, both listed an expense ratio of 0.03. That means that annual fund expense is approximately $3 for every $10,000 invested. Although brokerage costs, taxes, and other factors can also matter, these are examples for education, not for recommendations. Many providers offer similar funds, and investors should compare the index, fees, tracking, liquidity, tax, and their own goal. Why is this layer useful? First, diversification. So when one company struggles, the portfolio is not completely dependent on it. The index also changes over time. Companies that become larger can gain weight, while companies that weaken may eventually be removed or buy smaller positions. Second, low cost. So a difference of less than 1% may look smaller for 1 year. Over decades, higher fees can remove a meaningful amount from your final portfolio because the fee is taken and the lost money no longer compounds. Third, simplicity. A broad index fund does not require you to analyze every company before making each month contribution. Fourth, discipline. So when the foundation is automatic, we are less likely to change our entire plan because one industry is popular this month. But index funds are not risk-free. They can fall significantly during bear markets. They may also become concentrated in largest companies when those businesses dominate index. A US index fund does not automatically provide complete international or bond diversification. The foundation must still match the investor's time horizon, risk tolerance, and financial situation. So diversified portfolio does not guarantee it. It means less dependent on one company. Moving on to layer 2, that is individual quality businesses. So this is an optional. It is a smaller part of portfolio for individual companies that we have researched and can explain clearly. The word quality company are used very loosely. So let us define what does that mean. A quality business normally has a clear business model, consistent demand, healthy margins, manageable debt, strong cash generation, and a competitive advantage that may last for years. For example, Microsoft can be studied as an example for recurring businesses and cloud revenue. Visa can also be a good example of a payment network that becomes more useful as more merchants participate. Costco can be studied as another good example. Customers' loyalty, scale, and membership income. So these examples are not automatic buys. The valuation can still be too high, growth can slow, regulation can change, and competition can become stronger. That is why layer 2 require more work. So before adding an individual stock, I would want you to understand, how does the company make money? What is driving revenue growth behind that? Are margins and cash flow healthy? How strong is the balance sheet? And what is the competitive moat? What are the main risks and what future growth is already included in the stock price? So individual companies can make investing more engaging. We learn about technology, consumer behavior, healthcare, industrial production, payment, and many other industries.